Top strategists largely expect the stock market to continue rising but remain far below historic rates next year, according to several 2024 forecasts released this week, as stocks continue to recover from last year's brutal losses but struggle to return to their mid-pandemic highs. Goldman outlined several extreme, but plausible, 2024 scenarios where stocks could swing wildly. The bank said the S&P could rise as high as 5,000 if the Federal Reserve cuts rates earlier than expected. The market currently prices next May as the most likely time for this, or could fall to a two-year low of 3,700 if the economy does slip into a recession. The S&P, as well as the Dow Jones Industrial Average and tech-heavy Nasdaq, is fresh off its worst year since the peak of the Great Recession in 2008. The 2022 losses came as the Fed responded to record inflation and hiked the target federal funds rate up from near zero, where it sat since early 2020, kicking off the most aggressive monetary policy campaign since the early 1980s. Rates have since settled at 5.25% to 5.5%, the highest level since 2001. Though corporate earnings have proven more resilient than many feared at the beginning of the rate hiking cycle. Tightening campaigns typically precede recessions as higher borrowing costs cut into corporate profits and dampen consumer spending. But the U.S. economy has exhibited output growth and unemployment in line with historical levels throughout 2023. Ed Yardeni of independent firm Yardeni Research forecasts the S&P to head to 5,400 by the end of 2024, 20% higher than its current price and some 13% above its prior all-time high. Last year's brutal sell-off was due to widespread fears that soaring inflation would force the Fed to raise interest rates to levels that would cause a credit crunch and a recession, Yardeni explained in a Monday note. But the economy has yet to show signs a recession will materialize, and the S&P should continue on a path of strong gains should that continue, according to Yardeni.